Do you ever worry about the worst case scenario hitting your life? A market crash, lost income, a medical emergency. These events can drain emergency funds, max out credit cards, and even force early retirement account withdrawals. They are nightmare scenarios for most people, but it doesn't have to be for you. Today, I'll help you build mitigation into your plan so that you can be prepared to weather the storm. Welcome back to another episode of Escape the Clock, where I, the author of the book, walk through my strategies and ways that you can achieve financial freedom. On the personal front, I'm happy to say that my family was just approved as a dog foster family with a local nonprofit in our state. This was one of my early retirement goals. I am a huge dog person. I had done fostering in the past while I was working, and it was actually a little challenging. We would do what we could to help out, especially trying to help dogs that were in kill shelter situations. But it was actually really hard while working. I just didn't have the time and energy to do it as well as I wanted to. But now that in an early retirement situation, this is one of my goals, both giving back on the financial well-being side and helping people with that, but also just helping as many dogs as I can. We got approved really quickly. And almost immediately, a cute 4-month-old puppy was put under our care. She's a Chihuahua Rat Terrier mix named Squire. She's adorable, full of energy, as puppies tend to be. And I decided to do this because we're huge dog people, and we just have the time and I have the energy to focus on training, especially with my son moving out. If you'd like to see a picture of Squire, please subscribe to the Escape the Clock newsletter on the site. I send out an update every week or two, and this update by end of this week, I'm going to feature pictures of her, and eventually I'll send out information about adoption as well. Awesome. So let's get into it. Today, I'm excited to talk about a really important topic because last week we got into a lot of the behaviors about ourselves and just things that can really affect our plans. And what I was really getting at was risk. But I didn't really go deep into risk mitigation. Like, what do you do about risk? How do you make sure you're identifying all of it and then taking action on it? So let's start though, first talking about what's going on right now in the world, because we're actually in an interesting climate. One that where a lot of people actually are struggling, and this is a very relevant topic for most of us. So I was reading on the Wall Street Journal about this thing they're calling the silent crisis. They were covering how Americans in their 40s and 50s are facing financial instability despite having decent incomes. This can be people with six figures just feeling like they're really not getting ahead, and it can become pretty desperate. And when they were interviewing these folks, many were admitting they didn't have a plan, especially a plan early on, or any set clear goals. And I find this so common when I'm talking with people from the site. When people sign up at the site, and I talk to like friends and family. Everyone I talk to now, they have goals, but when I first talk to folks, they're not clear goals. Like, really know what you're trying to achieve. And that is such a staple of financial wellness. Anyways, I'm reading this article talking about the rise of like BNPL, the buy now, pay later, which is kind of like a layaway type of thing where you can do it online, where you can just say, hey, I'm only going to pay, $1 now, and I won't worry about the other $19. That's going to hit you at some point. There's lots of those things now, really getting people into over leveraged situations. Consumer credit card debt, a record high. There's also been a post-pandemic lifestyle inflation. People were antsy, to go out and spend, and they did. And it just created such lifestyle inflation that becomes very expensive to maintain, and it's not very satisfying, to be honest. So anyways, there's lots of good reasons for this quote unquote silent crisis. And the result is embarrassment and shame, and a lot of times delayed retirements. And so even if you're feeling okay, I'm sure you have worries. Everyone has worries when it comes to money and our own financial wellness. It's just natural to worry, especially after just experiencing a year of high stock market volatility, record volatility. We're seeing record job losses, income disruption, especially in like tech and financial industries. Healthcare costs have been hitting record highs, and insurance claims have been shown to be covering less and less. It's putting another healthcare crisis on our forethoughts. Fraud, scams, financial abuse, it's getting really scarily good. Even careful people can fall prey to this, as AI and other things make it really easy to be scammed. So I get it. There's a lot to worry about. Layoffs, reduced hours, skyrocketing prices, markets about to burst, unaffordable healthcare. It's honestly too much. But we don't have to be victims. We don't have to have these worries consuming us. Any risk can be mitigated. And that is what I'm covering today. How to ensure mitigation is part of your plan so that when the worst occurs, you are empowered to handle it and come out none the worse for the wear. Financial ruin is a real nightmare, and one that you've likely worried about. I've actually lived through it myself, and I know the stress that it can cause, and how that without a plan, you can really be stuck living in fear and just worried about getting through the events that you're going through. And that sometimes these things just happen and we end up in these kind of worst case scenarios. And, the financial ruin, these aren't always these loud, dramatic moments, and they can just creep up quietly by small things that build up over a cascade of events into something much more tragic. Let's take an example for a minute. So imagine it's a Tuesday morning and you read the headline, U.S. Treasury fails to make bond payment, global markets in free fall. What this would mean is that for the first time in history, the United States has defaulted on its debts. We overspent and overborrowed and built up too much national debt, and we're unable to pay back what was owed, causing countries to stop lending to us and creating a political gridlock. The dollar would be shaken, faith lost in the U.S., interest rates skyrocketing overnight. That would cascade to the bond market, going into a shock, investors demanding higher returns to compensate for the risk. That would freeze up banks. Credit market would freeze up. Credit card APRs could jump 5% or more without warning. Adjustable rate mortgages, bills could double. Stock market could tank. Retirement accounts would start to bleed. S&P could drop 30% in maybe 30 days. 401ks could lose six figures. And then, of course, companies would start slashing jobs so that they could refinance debts. That would result in mass layoffs of salaried jobs and many hours cut in hourly jobs. And then unemployment would shoot up, let's say 10% or more. Inflation would rise. Cost of groceries going up 25%. Gas gallon could be $8 or more. And you wouldn't be able to even get through to anyone on an unemployment benefit hotline because it would be overwhelmed. In this nightmare scenario, you didn't do anything wrong. You never thought the U.S. government would default, but it would be you paying the price. Because America, it's the safe bet. Jobs are secure, markets always bounce back. That's what we think generally. But all of that can be shaken on a Tuesday morning. Again, this is an extreme scenario, but it's one that kind of shows how sneaky and catastrophic financial disaster can be. And just because you haven't lived through financial disaster in your life doesn't mean that you won't. In general, that's something I have to tell even my kids is, you can have a comfortable life, but that doesn't mean you're not going to have struggles. That doesn't mean disaster can't occur. So you might not be able to do much about this national debt scenario, right? Unless you're a politician, then seriously, come on, you can do better. This is something we really need to dig into. But anyways, for everyone else, this is something that you can't really control, but at least we can do some smart things to protect our money and our livelihood if something like this were to occur. And that's the focus of today. It's about mitigation plans, how to protect ourselves, how to make sure that when things go wrong, we'll be okay, how to learn from what happens when things do go wrong so we can do better, how to build contingencies into our plans to take action when our predictions become reality. So let's jump in. I'd like to introduce you to Gao. He's a bit of a wild child. He's always done whatever feels right, mostly trusting his instincts when it comes to financial decisions. And it's worked out about half the time. But now he's realizing that the times it hasn't worked out has put him back. He's tired with work, and he's ready for the freedom to travel the world again, like he used to when he was a kid. But a discussion with a financial planner has woken him up to the point that his behavior has prevented that. His impulses have caused him to amass a larger lifestyle. He's too much debt, too little savings, because he's been on autopilot. And now he's aware that one more expensive life event could just put him into complete financial ruin. I'd also like to introduce you to Noctis. He grew up well off. His father had done well for the family, providing him all the luxuries he could ever care for. He never worried much about money, preferring to spend time with his friends. But a tragic death of his father put everything into perspective and put Noctis into the position of being responsible for his own finances. Furthermore, he recently got engaged, and he wants to ensure that he can provide the life for his wife and future children that he had growing up. But he's scared what happened to his father could happen to him, or some other disaster might ruin these new plans. So I will circle back to both Gao and Noctis at the end, and we'll talk about how mitigation can help them ensure that they aren't going to be the victim of financial ruin. The first project is about identifying and personalizing your risk exposure. Because before building steps into your plan to deal with risks to your financial well-being, you need to know what you're actually trying to mitigate. You can't mitigate what you haven't identified, in other words. But first, let me talk. I say the word mitigate a lot. And what do I even mean by that? Let's just start with the formal definition. Mitigate means, quote unquote, to make less severe, serious, or painful. It's a word used constantly in program and project management, because working towards a long-term goal means dealing with uncertainty. And uncertainty creates risk. And risk injects pain, financial, emotional, or logistical pain, really any kind of pain. So taking steps to reduce that pain isn't just smart, it's actually how we stay on track. But how can anyone possibly know the future? I don't know what's going to happen in the future. If I did, things would be much easier. And because we don't know that, we have to find ways and strategies to take control. So the short answer is we just can't know. But what we can do is look at evidence, evaluate what is likely to happen so that we can make smart, proactive decisions. And just know, it's not possible to catch everything. And that's not the point here, because catching even 90% of what might go wrong will dramatically improve our financial well-being. And it doesn't take all that much effort to get there. So to do this, first, we're going to start to brainstorm all the ways that things might go wrong. And this is just, again, simple questions we're going to ask ourselves as we go through our plans, such as what are most likely to go wrong in my life and derail my financial plans? Starting with a big question like that. So taking a step back, you have an idea what your financial goals are. Ask yourself, what is the most likely, the number 1, 2, and 3 reason that these things might not happen? Something should be popping up there. That we always have these prevalent worries in our mind. Those are the big anxieties. And those are the ones we might want to spend the most time building mitigations for. And I'll talk about how to do that in a moment. Again, we don't need to list everything. We're really just going for plausible threats, the things that are most likely to be a problem. And I'll talk about later how to handle the rest of stuff, because the unexpected will happen, and that's okay. We can still have plans and rails and things that can help us with those too. So anyways, let's go back to the main point here. Every single person, you, me, our family, our friends, every single one of our risk profile is different. So because that's so broad and because our risk, what we consider a risk or vulnerability is so different, let's narrow the focus a bit. So I'll narrow it down to 4 categories, all along the idea of a liability. A liability, if you're not aware, is something that you're responsible for. Or it's something that could become a burden if things were to go wrong. So a liability could be your job, it could be your health, it could be a relationship, or it could be something you own. An actual, like your home, your house could be a liability. So let's focus on those 4 categories again. These are the categories of personal risk in our lives that could affect our financial well-being: our job, our health, our relationships, and our assets. So if we look at those and we think about a personal risk profile, let's actually go through them one by one. Let's start with the medical stuff, medical liabilities. This is a common one that we will all deal with, and how we mitigate medical risk in our lives can make a big difference, because an unmitigated medical risk can create serious financial hurt. You may have heard stories of people dipping in and draining a retirement account because they had no other means to pay for a surprise diagnosis and things like that. These things are tragic, and the goal is to minimize the harm there. So what is a medical liability? These are risks to your health or some other medical event that you would be responsible for. And so you should ask yourself, what health events could create major costs for you or your family? And you might go, I don't know, it could be anything, right? Yes and no. There are ways to narrow the focus here as well. But generally what we're talking about is major illnesses, right? Injuries. So if there's a type of sport or activity that might cause injury, long-term care needs, especially if you're on the older side and you think you could be in a long-term care situation, really any kind of medical scenario or event that you might find yourself responsible for paying for. And then, understanding, especially with insurance, that there's still costs here, out-of-pocket costs not covered by insurance, and that certain diagnoses are going to be more disruptive to lifestyle or the ability to earn income than others. So it's about really rationalizing all that. And to narrow that focus, you might want to start by considering just your family history. Is if there was something that's impacted your parents or your ancestors, it's something worth considering as a risk to you or your children. So you can start there. You can ask yourself, does my insurance cover treatments for this? How my diagnosis impact my lifestyle, impact my ability to achieve my financial goals, things like that. So try to think through your entire medical profile, looking at risks wherever you can, and then you'll start to get an idea where those liabilities lie. On the income side, income liabilities are risks to your ability to bring in income around your job. So you could ask yourself, how secure is my ability to earn money? So, you might start to think about layoffs, industry disruptions, such as like with advancements, business failures, or, even things like AI displacement. That's a real thing. A lot of people are thinking about that right now. Any new advancement can create displacement. The main point here is anything that could threaten your primary income stream, your main income source. Your whole plan is likely built around this. So disruptions to it can be serious. So you need to really look deep at this income and how to protect it. And this might require doing a little bit of industry research. So based on whatever your job is, to just do a search and look around what's happening in your industry. Even outside your company, look at trends that are emerging, pay attention to the news, and especially things around your role. Are you in a role that could be outsourced, completely replaced, or flattened? Might changes hurt your job advancement goal as well, because sometimes it's not just about being having your role eliminated. It could be that you plan to make more money down the line, and there are things that you might anticipate hurting your ability to get a promotion or a new job or job transfer or things like that. So you should look at that angle as well. You can also look at what it would take to replace your income if it was disrupted. Also think about injury. Are you in the kind of role where there is risk to your ability to do the job? And I'll talk about later how we actually mitigate these things. Right now, we're just identifying risks, because once we have risks, we can come up with the plans. The next category is relationships, because relationship liabilities are those risks that come to us financially when it comes to all of the people in our lives. This can be things like lawsuits, it can be divorce, it could be even inheritance. So, good and bad, there's all kinds of things that come up financially when it comes to our relationships. So, you ask yourself, are there any legal or emotional ties that could threaten me financially? And just be honest. Is there anything that could pop up? And this could be someone close to you that you have a financial fallout with. Spouses, parents, siblings, children, friends, coworkers, neighbors, anyone could be relevant here. And really what it's coming down to is think about those relationships and any kind of a financial event that possibly could occur in our lives. And then as you think through these relationships and what risk could be present, you might just start to ask yourself some questions. If you're not married and you're thinking about getting married, you might consider a prenuptial agreement. Is that something you could consider? Not always a popular topic to have with your future spouse. I understand that. I'm just going to admit, I did have that conversation with my spouse. It was really clear that was not going to fly. And I realized, you know what? That's okay. I'm okay with that risk. I was committed to doing what I was going to do, and she was committed to what she was going to do, and we moved forward, and we both were okay. But there are post-nuptial agreements too. You can get married, and you can consider looking at that as well. If you're already married and you don't have a prenup, you might at least want to think about, in the worst case scenario, if things were to change, how would you finance a split? Especially if you have children. It's not always a fun thing to think about, and it can involve doing some awkward research, potentially even talking to a lawyer, and you have to be careful about doing this on your own. And it's better to disclose, hey, I'm just trying to look at every angle here. This isn't something I'm worried about. Or if this is something you're pursuing, I'm sure you're already considering this, better to do it earlier than when you need it. Or just acknowledging it's a risk you have and you're not going to take action on it. That's fine too. We can identify risks and not take action on them. That's fine as well. Maybe though you have aging parents or siblings or someone who might end up depending on you, someone who might need money from you. You should think about those things as well. Inheritance. Are you actually counting on inheritance as part of your plan? Are you actually building out, okay, I'm expecting to get X amount of money at some future point. It could be a hope, or it could be something you've actually planned for. But keep in mind, disputes could arise. You can actually look at this risk and you go, oh, is there a possibility that I'm not written in, or it's not clear and there could be an argument or a conflict? What happens if that inheritance doesn't materialize? Or in general, is there a risk of lawsuit from anyone in your life? This could be a neighbor or a coworker. It could be just a stranger. You can think about those risks as well. The last category is asset liabilities. These are risks regarding the things that you own, especially financially relevant assets like real estate or cars, but also the accounts that you have. And if you're doing this, you have these accounts, right? 401ks or 529s or checking accounts or savings accounts and all that. Those are assets. They're part of your plan, but they're also liabilities as well. So you could ask yourself, what do I own that could lose value, be damaged, or become inaccessible? So as you ask that question, you start listing these things out. And you see that the accounts and assets that we own, they actually make up most of our net worth. When we look at our homes, our cars, our bank accounts, all those things, all of those things are part of the calculus. And if you look at the Escape the Clock planner, you'll see that actually it is part of the calculation for net worth. We look at all of those assets and liabilities, and it really sums it all up. Anyways, risks to the value, control, or liquidity of these assets, those risks can be catastrophic. Because imagine you lost all access to your 401k, the whole thing. Now, if you don't have a 401k account, you might go whatever, but like put your main account in there, right? It could be a brokerage account, savings account, whatever. Imagine you lost access to that. You just couldn't even log into it. It's been stolen. That is a really tragic event. It could create real heartburn and stress. So, this is where we start to consider the rest of these assets going wrong. So let's start with your home. If you have a home, is it fully insured? Especially protected against the most likely disasters for where you live. I remember where we were looking at homes in Washington State. Some areas there was fire risk. Some areas it was earthquake. Others there was even like mudslide risk. Near certain mountains and stuff. So it just depends on the area, and it's usually pretty common for them to already consider insurance there. But you should look, and you should make sure you don't have too much risk in that area. Also, you should ask yourself when you look at these assets, am I over invested in one versus another? For instance, like if you're putting everything into a brokerage account that's invested in the stock market, could a market crash completely crush your net worth overnight? Same with real estate. If you're going all real estate heavy, which I know a lot of people do this, as a real estate market crash, will that crush you? This is risk. Over investment is risk. So looking at this can help. Also, what happens if you can't access your retirement accounts? Is everything in one retirement account, or using multiple retirement accounts? If you couldn't access that 401k, how long would that set you back? Are you able to still hit your goals without it? Just generally asking yourself, is my identity safe? What happens if my identity were to be stolen? If access were to be taken? So these are the kinds of things that we have to ask ourselves. These are not always fun topics or conversations, because when we're looking at risk, we're thinking about worst case scenarios. So again, not always fun, but by doing this, what we're doing is we're buying ourselves peace of mind, because we're going to take steps to say, no, I am covered. I am likely okay. Because even if the worst case were to happen, I'm not going to be reacting. I'm actually having a plan to put into motion. I also just want to mention the Escape the Clock planner that I give out. It is a good way to list this stuff out and figure it out. You can use the retirement planning sheet to look at your liabilities and your assets and start to get a clear picture of your profile. It's both to help you get that profile put together, but also a projection of where you're going to be in the future. So as you go and look at that, you can go, oh, okay, I'm really doing really well here, but because I'm doing well here, there's risk here. Or, oh, my debt's really high here, and there's risk there. So, you can start to put your finger on the risk as you're putting together that picture. Awesome. So I guess I would just ask you, is the risk forming in your mind? As I mentioned, retirement accounts and savings accounts, investment in stock market or real estate, or relationships, all of these things. Are you starting to get an idea of where your worries have been? Even if they're not foremost on your mind all the time, they're probably there somewhere. And if they're there, if they're starting to come out and you're seeing those, good. Because in the next project, we're going to turn all those insights, all that work we did, shining a light and identifying these things, into an actual risk mitigation plan. And that is going to be the blueprint for protecting what's most important to you. Now that you've identified the major risks to your financial well-being, the next step is to mitigate them. So project 2 is about building the risk mitigation into your plan. And this is to reduce the impact of these risks, ideally before they become a reality. Let's be honest. After brainstorming everything that might go wrong, it can be very easy to feel overwhelmed. Again, these are not fun things to think about. We're just doing our due diligence to take care of ourselves, our loved ones, and our financial well-being. But chances are you already have some instincts about what you want to do. It's hard to think about what you're worried about without having some idea what you want to do about it. Now, I have no idea if the thing you want to do is something you feel empowered to do, or something you haven't gotten around to doing, or something you just need a little encouragement to get into your plan to take action on. Whatever it is, getting it into the plan is always a good first step. And even in the cases when you're unsure what to do, there are tools that can help you figure it out. And so I will talk about actual strategies later that you can do to harden up your financial plans, so that even if you're unsure what your personal risk profile and risk mitigation is yet, you can still put some of those strategies in place to have more protection than you would have before. And by the end of this project, at the very least, you should have a hardened financial plan, because this is about mitigation and building it in. And the idea here is to reduce emotional paralysis. Because when we haven't thought ahead and put some steps in place, contingencies, what happens is when those things occur, we freeze up. And that's actually really natural. If you were, let's say you're driving a risky route every day and you're just on autopilot, you're just driving, and one day you have a car accident, your brain kind of goes into a lizard mode, is what they call it. But it's basically an emotional paralysis. The emotional event of an accident can just cause you to completely freeze up. You don't know what to do. You don't know what the next action is. You just sit there, stuck, unsure, just needing help. But let's say that you actually thought ahead and said, okay, this is a risky route that I take every morning. An accident could occur. If an accident were to occur, I will have to make sure I have my insurance information available. I'll make sure it's here in my glove compartment. It's up to date. I know the number I'm going to have to call. I know I need to contact maybe my job and let them know I'm going to be late. I have that as my second number I'm going to call, and so on. And then if the accident were to occur, your brain is not going to go into paralysis. It's actually going to kick into your plan, the one that you just ran through mentally. You don't have to pull it up or anything. It's already there in your head. You've cached it away, and you'll actually find yourself going through those steps. It's kind of an amazing hack. The more we think through contingencies, the more our bodies will kick into gear when we need them to. Now, you can take this to an extreme. I think I've done that a few times, where I may be even a little paranoid, where I will be sitting in a restaurant worried about something going wrong, or a movie theater or whatever. And I'm thinking, okay, I should sit in this spot. Make sure I know where that exit is. Especially when you have kids. I think kids put my brain into a paranoia overdrive a little bit. They're older now, so it's dimmed down, but I think that's maybe natural. I hope. Otherwise it's just me. But the point is you can use this, I think, to a healthy degree, but if you're not careful, you probably take it too far. But the idea is that you kick into that mode when trouble comes knocking. And so I'm going to introduce you to two powerful techniques that I cover in the book here that will help you go and do this. They're called the pre-mortem and the post-mortem. You may have heard of one or both of these before. They're great techniques, and you can use them many, many times in your life to get prepared. But for this project, I'm actually only going to focus on the pre-mortem. I'll get to the post-mortem later. And let's talk about it, because as I talk about what this is, I think it'll be clear how this will help you build your mitigation plans. So a pre-mortem is a technique where one or more people imagine that a project has already failed. And then you work backwards to identify the reasons that it might have failed. So you're imagining the future for this thing that you care about, like that drive that I mentioned. And you're going, what could go wrong? How did this accident possibly occur? What could I have done to prevent it from happening? Could I have taken a different route? Maybe one of the lanes was riskier than another. Maybe a certain time of day or weather condition, things like that. Anyways, the pre-mortem is allowing you to do a thought exercise, either in a group or individually, to start to create a mitigation plan. So again, this is putting you in a proactive mindset. It's helping us think through and identify risks and weaknesses early to help lead us to corrective actions. And by doing that, we increase the likelihood of success. So to do this, it's actually really easy. Just review any one of your projects in your plan. It could be a retirement saving project. It could be a debt elimination project, whatever it is. It doesn't matter. Just pull up any project and then ask yourself, how could this go wrong? And what would I do about it? Now, you might have already done the how could this go wrong part in the last project. That was where we identify risks. And we need to do that before we come up with the mitigations. The pre-mortem kind of packages these. It's both the assessment and the action plan piece. But what would we do about it? That's actually what's really powerful here. And this is such a powerful tool that companies use this all the time. And as a person who worked as both a product manager and a project manager, I can tell you that this was just a normal staple of my job. I would host these planning sessions with teams of people across all these other disciplines, and we'd sit in a room for hours at a time. And what we were doing there is I'd be leading them through priorities and objectives, and then we would spend the time fleshing out details. So, we'd have some big objective and say, okay, well, we're all on the same page now about what we're trying to do here. How are we going to do this? And everyone had a role to play, right? So, sometimes it would be like they would come up with planning out their section, or we would like collaborate on things that we could do. And what we're really doing is we're trying to create a specification about how to build something or accomplish something. And we would never be able to complete the specification without a risk section. Like every template would have like a risks area to it. And in those risk sections, it could be things like security issues or privacy issues or like whatever. There's lots of different types of things that could go wrong. And what we were really doing though is we were doing a pre-mortem. And so we're thinking like, okay, for this idea of this thing we're going to make, that design that we've been discussing, what are the risks? And maybe like user privacy data could get leaked, or maybe the system could go down for some reason, or, it could be anything. And people are just brainstorming these things and throwing them in there, and we're collecting them. And then we start asking ourselves, okay, if that were to happen, well, what do we even do about it? Can we prevent it? And if we can't prevent it, what steps do we take? And that's actually really powerful. And it's not even just something you would do in like a business field. You can do this in your normal life. So let's take a scenario there. Let's imagine you're responsible for organizing a family reunion. You have 15 people that you want to attend this reunion in Colorado. I'm just making this up. So let's say your reunion's in Colorado, and you have all these 50 people. They're spread apart. They're across 4 different states, and you want to get them together at this cabin on Christmas week. And, okay, that's the scenario. You are going to organize family reunion for 15 people across 4 states on Christmas week in a cabin in Colorado. Maybe it's not a cabin. Maybe it's something bigger. A place that has plenty of room for these people. Anyways, on paper, that might sound simple, but as you can imagine, this is actually a very difficult thing to plan. With so many people, getting them all in the one place at the one time, the dynamics of personalities, the logistics of moving people, the money stuff, all of that. There's a lot of risk buried in this one scenario. And so let's talk about a pre-mortem here and how that might help. All right, I'm going to make up 4 risks, and then we'll talk about what you might do about it. So let's start with, let's say you have 2 cousins from they're in two different states, cousins Barry and Tim. And let's say they don't agree politically. They argue a lot. They have a contentious relationship. They're seen kind of arguing online. And, you hear from their spouses that they're hesitant about now getting together. Like they've committed, but they're not so sure it's a good idea getting them together with the broader family because of how these arguments have been going. Okay, well, that's a risk. Now, your main objective is getting all 15 people together. Now, you have two entire families that may not show up. What are you going to do about it? And so there's lots of things you might do, but the first thing you can probably consider naturally is just talking to the cousins. Maybe proactively just speaking with each of them individually, trying to make it clear to them that this isn't about their feud. This is about the get together. It's a greater purpose. Maybe you even need to set some rules. Like these are going to be the house rules, or, it's a no politic talk while we're on this trip. And you might even create other contingencies to make sure that things keep on track, like keeping people busy the whole time, having lots of activities that don't trigger any kind of political talk. Because, when people's minds go idle, they go to the thing they want to talk about, things like that. And you might even have an idea of telling people to watch for and redirect that kind of talk if it were to come up in the moment. So you're really thinking through, what do I do now before the event? What do I do leading into the event? What do I do during the event to mitigate this? Okay, another scenario. Aunt Liz hasn't flown in 20 years. So your aunt really wants to come, but is very nervous about flying. And cousin Tim has said that, hey, she hasn't even booked her flight yet. So there's a risk. There's a risk. If she's not booking the trip, she's obviously worried about having to fly now. So you might reach out again and connect with her, hear her out, see what her worries are, see if this is a real risk. Assessment is an important part of this process. You really do need to assess, is this a real risk or not? Do I need to worry about this? Now, let's say it is. Let's say you hear a lot of worry about it. You might have to then gauge, do I need to do something about this? And then you might offer like, hey, it's going to take longer, but there's a train you could take. You don't have to fly. Let me help you figure out how to book that and get there and do that instead. You could leave earlier, that kind of thing. So you can find ways to help her and she'll feel heard, and then the risk is mitigated. Maybe a bigger, more complicated one, though, could be that maybe two of the families might quietly back out because of money. This one's really tricky. This is a risk that might not even be evident because no one's talking about it. Money is typically not talked about. It could be a shameful thing. And these families might have been struggling financially, and this could be a silent risk. But you know them. There's been struggles, even though they haven't expressed concerns, that this could pop up and you might get a last minute cancellation from one or both of these families with some kind of made up excuse because, this is a source of shame for them. So this could be a good one to get, a group together to discuss sensitively the issue and how to help them be able to become there without money being an issue. Maybe you organize like a buy-in travel budget or something where everyone can contribute money to a pool with no maximum contribution. That way the people who are more financially well off can contribute enough to help support the ones that can't contribute much. But the ones that don't have as much money can contribute a little bit and still feel like, hey, I'm not getting a hand-me-down here. I'm not getting a freebie. I am putting something in here. But what that's doing is it's allowing you to mitigate this risk while, helping everyone preserve their dignity and even help like they're giving and you're bringing people together. So sometimes the mitigations can strengthen our plans. So maybe this kind of thing, this action alone could make the family get together, the reunion, more positive. It could be a moment of conversation. So it's actually strengthening the main objective. But let's talk about one more. Let's talk about one that you might not feel like you have any control over, which is you're traveling on Christmas week to an area that sometimes have bad weather conditions. The airport can get backed up. Flights could get canceled. I mean, you can't control the weather. Definitely can't control airplane cancellations, flight cancellations, and things like that. So you might find like, I can't really mitigate this one. But the truth is you can mitigate anything. There's always a plan somewhere, even if it's not an ideal plan. You can come up with something. So in this case, maybe you just add a buffer day. So a day earlier, set aside just for travel. No activities are planned. It's only a travel day. And that way it'll alleviate stress if things start getting delayed. You already knew that you had time for people to travel the day of the event anyway. So if things get pushed over, it should work out. But even so, again, backups are always good here. So you could have a group chat for logistics where you're like, hey, when you're traveling, things might go wrong. Make sure you're using the group chat, post messages, updates, ask questions. We'll share information. We'll help each other out. And you can even post backup travel plans to that group chat if needed without diluting and confusing people. As a project manager, I can tell you, communication's everything. And it's not about over communicating necessarily. It's about communicating, having all the ability to over communicate, but controlling the flow of it. So, knowing that you need to put the plan up when it's needed, that can be very powerful. But putting it up early, people won't really read it. That can be frustrating that people aren't reading the information you prepared. And then, they're not acting on it because they missed it. And then they have to go look it up. And that's harder than having it just appear. Anyways, look, this is just an example of how like a real life thing, something that can be actually pretty complicated. It can be simplified with just some basic risk planning and mitigation planning. That's all we did. And we used a pre-mortem here to think through what could go wrong, put contingencies in place. And they can be things in advance, like the train ticket for Atlas, or the just in case things like the chat room and the travel plans on the day of the event. But let's now take this back. Let's circle, now that pre-mortem hopefully is clear, let's talk about how to apply that to those risk exposures that we identified in Project 1. Let's start with mitigating financial exposure. If you remember, we talked about too much in one area is a risk. So if you have everything into like one stock, or if you have everything into a real estate property or a savings account, that is risk. And that can be mitigated. And this gets us to the most timeless strategy there is, which is diversification. If you're listening to me, you probably already know what diversification is, but if not, it's just a way to spread apart so that we alleviate risk, because we don't have all of our eggs in one basket. We don't drop that basket, lose all our eggs at once. We spread them across. We're protecting them. So, and then this goes way beyond investing. Like this should be considered whenever possible. We can diversify risk everywhere in our lives. So let's go and talk about the market thing though, because that's mostly where I see this. I know that I have people who are really heavy into real estate. They have everything in the real estate market. And of course, a market crash could create financial ruin. Same thing with the stock market, or putting every single thing into a single bank account when you have no other investment. So what we do here is we spread things around, but we spread them around where it makes sense. We don't just spread things to spread it. Certain accounts have certain advantages, and we want to leverage those advantages. And some stuff doesn't have liquidity, meaning it's not easy to move stuff. So we need to be very deliberate with our contribution strategy, like why and when we put something into something. And the idea here is really, it's just about the accounts that you've opened. So let's say you have a work retirement account. You were given like a 403B or a 401k. You should also consider opening a personal retirement account. It can be a Roth or a traditional IRA. And which one you pick, you should listen to the retirement episode to understand the differences. You want to diversify even your tax strategy if you can. If your 401k is pre-tax, you might want to really lean on the Roth IRA because of the after-tax to minimize required minimum distributions later. If that doesn't make sense, again, go back to the retirement episode. But the point is you can diversify and diversify and diversify. You can do it in layers. So instead of putting everything into your savings account, let's say some of what you're saving for is your kids' college costs. And you're like, okay, I know that $80,000 of my savings accounts is earmarked for tuition and other stuff. No, use a 529. Go back to the college savings episode I did. A 529 account has multiple tax advantages for this purpose and is invested, and it separates the money and protects it differently than your savings account. Same with medical. This is why you want to have an HSA. If you're qualified to get one, you should definitely have one. It separates your medical expenses. If you run a business, think about having a separate checking and savings account for your business. You're protecting yourself and you're making your taxes easier. Diversification is key. It's about thinking about the intent of the money. What is the money for? And how do I protect it? And there's additional things we can do to protect it in those accounts. Those accounts have features that can protect the money as well, and sometimes insurance. But the idea is to avoid overexposure to any one sector or one asset class. Let's go back to investments for a moment. For me, I was overinvested in stock market investments in tech. This just happened to be because of my job. And so it was actually something that was bothering me for a long time. But I know that selling some of those gains and then reinvesting the cash from those sales into any other area is a diversification. Now, clearly I can diversify further in some ways than others. So I'm actually focused on moving those, taking that cash from those sales and moving into real estate. That's what I'm personally doing, but you don't have to do that. Like, you could just pick a different stock of a different sector. Just don't pick tech. Just pick something else. Any different sector could be great, but other asset classes work well. So diversification, huge strategy, and it's actually not too difficult. Let's talk about income though. Income diversification. What does that look like? We talked about the income risks. If you were to lose your primary income, you could be in trouble. Clearly, if you had other income sources, that would lower the risk. A secondary income source could be huge. And this comes through side gigs, but for me, it came through passive income investments. So because I was stock heavy, I made sure I always had dividend payments coming in. My high yield savings account generates good interest. My certificate of deposits generate good interest. And eventually, I'm not there yet, working on it, real estate can have rental income. So things like that. Passive income is an income source. It actually can get taxed. It gets taxed as well as income, but your primary income is definitely probably your main thing. And you're not going to have enough likely in secondary income to completely mitigate losing your primary income, but it does happen. I know I've heard stories of people doing so well building up their secondary income source that they just quit their job because they don't need their primary income anymore. And they enjoy doing what they're doing to get their secondary income. So you might actually find it's a fulfilling activity, trying to mitigate this risk. It doesn't have to be a bad thing. It can be fun. You could be working on that thing you want to work on, that dream you have, that thing you lean into in a retirement situation, just because you know, hey, if I lose my job, it's not the end game for me. I'm going to be okay. And clearly there's things you can do without creating new income sources to ensure that you're okay with your primary income, such as like just building new skills, ideally outside of your current domain. Building new skills within your current domain, that's smart too. You want to have as much value as you can within what you do, especially if a new opportunity comes up. You can raise your hand and say, actually, I have that skill, or I'd like to learn that skill. It widens your value. But having a skill in your sector or even a new sector, that creates diversification when it comes to what you're able to do to the value that you can provide. So let's say that a whole role is eliminated at your job, but another role exists. They don't always want to lose people. They don't want to lay everyone off. Not really. If they are hiring in a different area and you can do that job, very likely a conversation is all you need to go and make a move. Now, it may not pay the same. Maybe it pays better. I don't know. But the point is you didn't lose your income. You made a change. On the medical side, it's a little different. In the U.S., medical is really difficult, to be honest. This has always been one of the most frustrating parts of my plan. But here I would suggest thinking about a blend of preventative care and financial planning. And what I mean by that is the preventative care, a lot of insurance will cover it 100%. This is stuff like just working out, vitamins, just using your medication, as it was intended, and using pre-care health visits, like getting annual physicals and stuff. That stuff can prevent bigger issues, and that could just be a good thing you do for yourself anyways. But on the financial planning side, just leveraging the benefits you can get where you can get them, such as like a flexible spending account. If you can get an FSA, you can cover all your current costs with that. And then if you do that while building up an HSA, that HSA, health savings account, can cover all your future long-term costs. So now you're covered on multiple fronts, and you diversified how you're protecting yourself insurance-wise. Some people will get multiple insurances. I couldn't afford this, but like I know some people will say, okay, I have 2 insurances, and sometimes it's not allowed, but they'll diversify that way. And then there will be some contingency insurances like COBRA plans and stuff that can kick in through work coverage in the case you were to lose an insurance and still need care. Sometimes those have like limits though about how long they'll provide coverage. So anyways, you should look at that. You should understand like, okay, well, if I were to lose coverage, do I have something that can cover me? If I maintain coverage, do I have other things I might do to mitigate my own health and risks there? And diversifying can help. On the relationship side, it really just comes down to using legal tools. You can diversify by creating legal agreements. Like I mentioned prenups before, but there's also trusts, power of attorneys, and also insurance and estate planning. Creating these documents diversifies how you're protected. And so you can protect yourself on all these different types of categories or angles when it comes to your own estate, when it comes to inheritance, when it comes to your marriage, when it comes to legal protections with your business, or even in your own home, what insurance you have in your home. Things like that can protect you. So insurance and these legal documents is how I diversify there. Okay, so I just covered how to build mitigation plans using pre-mortems and diversification in particular on mitigating financial issues, especially around exposure. But what about yourself? And last week, I covered some of the behavioral psychology that can create risk in our plans when it comes to our own behaviors, like what we're doing. And these are behaviors and blind spots and impulses that can really create issues if we leave them unchecked. What do we do about that? That's a risk. How do I mitigate it? Well, this one's tricky, right? Because this is one, it requires us to be honest with ourselves. Are we the problem? Or, is it someone else, again, a relationship creating that? But if it is us, mitigation is going to come down to those actions I talked about last week being put into your plan. I didn't talk about pre-mortems last week, but you can imagine tying these things together. As you understand these different psychologies and behaviors, you're going through either with money scripts or something like that to identify things, you're creating action plans. That's the important part. Those action plans is your mitigation plan. And so, for instance, let's say spending is the issue. You just know I'm overspending. This is a problem I'm having. Having a plan now will help you when the urge hits to spend more. Cooling off periods. So you spent and you're not allowed to spend again for X amount of time on emotional spending issues. That can help. It really can. So there's lots of tricks you might do there to get control of spending. What about risky investing? Let's say you're, and I think I admitted I've done this a few times, but if you're prone to a little impulse investing, well, you can create guardrails for yourself. I'm not allowed to trade after a certain hour, right? Like, and stock markets aren't open all the time. You can create a window of time you're not allowed to make any trades on yourself and hold yourself to it. Or you can say, I'm only allowed to do auto investment. I'm not going to do any manual trading. Like, you can go as far as you need to go here. Inflation can be an issue. You might find costs aren't under control. Well, you can stress test your budget. Add a 15% cost increase. Can your budget hold? You can do a lot of this stuff with the Escape the Clock tool. I have a way for you to put anticipated inflation numbers into one of the columns, and you can see how your cost of living would change year over year. You can play around with this and stress test your life and see how well you can do. And really, it's about self-mitigation. But self-mitigation, it's about self-awareness and understanding the systems that drives us. So again, check out last week's episode for more about that, because understanding those systems can help us do more here. Sometimes, though, it's not us. Sometimes someone's coming after us. And I'm not trying to sound paranoid there, but identity theft and fraud are real. You likely have heard many stories or know someone or been through it yourself. I've definitely had my information leaked before, and I've gone through a lot of steps myself. And the more wealth you build, the more of a target you might become. So the better you're doing your plan, the more this is going to be a big thing in your risk profile. And sadly, it's no wonder so many people prefer not to celebrate their financial successes. If it only makes you a target, why would you be talking about it? That's a bummer, but that's the truth. But there's things you can do here. First, consider securing your identity by freezing your credit, and especially think about controlling your privacy online. Freezing your credit is actually pretty easy to do, especially if you're not actively taking out loans, and it's easy to lift. And it's just a very strong layer of protection. My credit is frozen all the time. I have a permanent freeze. I have my second credit. I have two credit cards now. One of them is active. The other one is always frozen. I just don't allow transactions to it. It's an emergency card. So make it work for you. Also, when it comes to online, strong rotating passwords, that's great. But two-factor auth. Someone who worked in tech, I can tell you, just use two-factor auth every single time it's offered. Just do it. You will make it much, much harder for yourself to be hacked that way. And just like generally learning about like phishing and impersonation scams and just social engineering attacks, that's really great. I don't normally talk about culture stuff on the podcast, but there's a show called Mr. Robot, which I actually found to be a little bit educational when it came to the extreme of some of the, I don't have a real, some of those are, but some of the scams in that were, I thought, really fascinating and shows you how clever people can be at taking some of this stuff. But with artificial intelligence, it's just getting harder and harder. Like it's becoming more human looking and it's harder to spot things every time. So we have to protect ourselves. We have to stay ahead of all the threats. So just in general, treat cybersecurity as part of your financial hygiene. Setting quarterly review reminders to look at how well you're doing at protecting yourself. That is a good thing to do. This is again about preventative stuff. And now if something were to happen, you were hacked, of course you can go and take action there as well with your credit reports and stuff like that. So for now though, really think about what you can do to protect yourself online. Outside of that, you just know you can't catch everything, right? You might mitigate yourself. You might mitigate identity and fraud. You might mitigate, being overexposed. But what about the unknowns? Well, this is why resiliency buffers exist. A resiliency buffer, it's about redundancy. And having a resiliency buffer for that and everything else category is actually really smart because we can't predict everything. So this is the last piece of this project. It's about building one of those because we can't predict everything, but if you have have actual savings in place, they can absorb the unknowns, then we are protecting all the rest of the stuff we missed. So this really comes down to just making sure that you have some level of emergency savings in your life. And this is why you hear this so often. Emergency savings, emergency savings. You need some emergency. That they don't always lead you through it the way I did today with all the projects and stuff, but it's about this case, the case where something you missed pops up and you need a buffer to absorb it so that you're not taking a hit that's harder to recover from. And liquidity is key here. Like, this isn't just about having the money to absorb it. You really do want it in a savings account. You might need quick access to this money. So there can't be a holding period or a penalty. You don't want that. You're trying to minimize the impact for needing this. So I highly recommend HYSA, high yield savings account, because it's a multi-purpose thing. It's a passive income thing, high interest rate, compounding. You're making money from it. And the more you put in it, the more you benefit and the more insurance you're giving yourself. But at least try to aim for 6 months. At least 6 months of essential living. I say 6 months of cost of living, your overall cost of living. But if you just want to do your essentials, that's fine. But again, the more, the better. The more risk, the higher your cost of living, the more you'll need though. So keep that in mind. The number could be a little daunting for you. Also considering work resilience. So it doesn't just have to be an asset creating resilience for you, like a savings account. You can think about it from a work perspective as well. Again, I talked a little bit about this before, but having skill redundancy. So you know your next move before your job loss. So you already have a backup plan. You're like, okay, I have enough money in place. I can cover myself for 12 months without my primary income. Now, that might be a lot of money in a savings account, but if you've saved up your cost of living, you're okay. But what you're doing is you're buying yourself time to build a new skill or pivot career or for a market to recover. And this can really make a difference. You can use that time almost like an unpaid sabbatical, right? Time off, time to try to recover, enjoy, get over burnout, whatever it is. It's not part of a retirement plan. It's a mitigation to losing your primary income. But if you're worried about, not the money not being the issue, if you worry about it being a skill issue, you can work on building those skills now, even before you have the job loss situation. But there's other things you can do too. Disability insurance or other insurances in case of the loss of income, especially if you're the sole earner or in a high risk role, that can make a big difference. The last resilience I want to mention is tax resilience. Often this comes down to just understanding tax law, which can be boring and not something anyone wants to do, but you don't have to do it. You can just talk to a tax advisor. Just talking to a CPA can usually be enough to mitigate risk here. But ideally doing this before tax season is what I recommend. Many times they will meet with you earlier in the year, as long as you've committed to doing your taxes with them. And you can have a discussion about your concerns, your risks, or tax implications. Because a lot of costly mistakes come from misunderstanding taxes. And you can avoid that. Just talk with that tax pro about any major decisions. It could be inheritance, liquidating one of your assets, making a big investment, whatever. It costs less to ask than it does to fix it much of the time. Awesome. Okay, so this project was a little heavier, but what it comes down to is mitigation. And mitigation is just thinking through and building what you need into that plan in case things go wrong. And mitigation, it doesn't require perfection. It's just requiring you to be prepared. So whether it's a backup travel plan, a savings cushion, or a legal document, these are guardrails. And they're your plan Bs. Your plan A is nothing goes wrong. That's your main plan. Your plan B is, okay, in the case that something likely did go wrong, this is the steps I take. And you can have as many backup plans as you want. The more the better, actually. Because the best professional risk managers, they will actually have backup plans for backup plans. So next, I'll actually go through that and cover what it's like to be a professional risk manager. You've considered the ways things go wrong and the strategies to prevent or mitigate those risks. But what happens when something truly unexpected disrupts everything? Project 3 is about executing your plan like a risk manager. Because look, you're going to miss a key detail. We all do it. Those blind spots will become painfully visible, and we'll all face these humbling moments. They don't make us weak. They just make us human. But if we're doing this right, these can be turning points. Each one of them is an opportunity to learn and get better at the next thing. The path forward is to think like a risk manager. In the last project, I introduced the pre-mortem. It was that proactive tool to imagine the failure in advance and then work backward to avoid it. Now I'm going to talk about the other half of the equation, the post-mortem. This is when things do go wrong. The post-mortem is going to help you assess what happened, why it happened, and what you'll do differently going forward. It's about truth, not blame, learning, not lamenting. This is important. In a post-mortem situation, usually emotions are involved. Like something went wrong. It's not a happy time. It's not about blaming. We got to figure out what happened so we can learn from it. You might not be surprised that in my career, we use these often as well. In both the tech and business world, postmortems are a core part of incident management. So a system goes down. Typically what happens is engineers will swarm to try to get the functionality restored. And then there will be a debrief period where everyone's looking for the root cause. The postmortem process will kick off, and all these experts are assessing what happened. And usually that will result in these post-mortem AIs or action items. So these are things that the teams would commit to doing to mitigate future risk and prevent like another catastrophe from occurring. So at my job, the pre-mortems are us like imagining like what we can do to make our plans as resilient as possible, but things go wrong. And when they do, we miss something. And that's when we use the post-mortem to figure out what we missed. And the best teams are using these post-mortems and feeding them into their next pre-mortems. They're learning from what went wrong. And when they're planning the next system, they're even better at it. Those teams are amazing. I think I wish we had a culture in the tech industry where we standardized that type of planning rhythm, because then, you know, these systems would almost never go down. But the truth is, you know, there's a lot of ways things go wrong and things are always changing, and these systems have a lot of variability to them. And so we're going to miss stuff and we need to learn from it, and learning just never stops. And the mindset here I'm talking about, this doesn't just apply to systems. This applies to you. This applies to your program. Using it will build up both financial and emotional resilience. So pre-mortems are used in planning to prevent failure. Post-mortems are used after the fact to learn and put learning into action. And doing so will not only give you closure. So doing this is worth it. You get some closure on what happened, but you're sorting out the chaos so you can have some confidence in how you're going to move forward. And while not a formal post-mortem, I can give you a real world example here. Something really, really relevant. It affected my life heavily. It likely affected your life too if you're around my age or older. But during the 2008 housing crisis, we all went through something that required a large postmortem. So the U.S. housing bubble began to burst in 2006. If you're not aware about what happened in this crisis, what happened though, this triggered a massive wave of mortgage defaults. So people basically just could not pay the bills on their homes. They were defaulting. And in this, as you can imagine, all those payments, all that money stopped coming into the mortgage companies, and the mortgage companies started to have a financial collapse. And the government stepped in to bail out many major financial institutions. But tragically, most homeowners were left to face foreclosure and financial ruin alone. So there was a bailout for many of the big companies, but many individuals who needed help did not get it. It was a complex and politically charged moment, one that demanded a lot of rational analysis to prevent history from repeating itself. Hence, a postmortem had to happen here. There was a collapse of Lehman Brothers. This happened in September of 2008. Many look at that as the spark, but the truth is that was not the root cause. Without the postmortem, we would not have the root cause. Many people would just point to that. The truth is they found that it came from years of predatory lending practices. And because they actually found the real root cause there, real change could happen. So lenders had been issuing high risk mortgages to borrowers who had poor credit. And they would often tease these rates, really, really, really great interest rates. And of course, how would you go, oh, wow, I only have to pay 2% or something? Of course I want that. But what they were getting into were a lot of these adjustable rate mortgages and other things that would then change to a much higher interest rate later that they could not possibly afford. Also, prices in the industry were soaring. Everyone was trying to get into the housing market. It was becoming an unsustainable high. And so both borrowers and lenders were just taking on more and more risk all the time, assuming the prices were just going to keep rising. And of course, as soon as prices don't rise, we're going to have a collapse. Also, on top of all that, credit rating agencies were being paid by the same firms creating these mortgage-backed securities. And so they had incentive, the credit rating agencies, to give inflated ratings to these companies. So no one had any clue these companies weren't being rated badly or anything. Plus, regulators couldn't even keep up what was happening here. I think it was later called the shadow banking system or something. But anyways, regulators were they had no ability to do anything, or they just were so far behind it didn't matter. It was a mess. And so the postmortem happened. It was very thorough. It took a while. It identified these systematic failures, and it led to a dramatic overhaul of financial regulations, most notably the Dodd-Frank Wall Street Reform and the Consumer Protection Act of 2010. So these were legislations that happened that created new safeguards. A lot of stuff came out of it, but I mentioned some of these problems. So some of the things that rails came in place was regulation of large financial institutions so that we could start to monitor risk. The Consumer Financial Protection Bureau, you may have heard of this one, the CFPB. This exists to protect consumers when it comes to using mortgages, credit cards, and loans. I've used it. You may have come across it, at least in a web search or something. That exists because of this crisis. Also, oversight of credit rating agencies. This really started to standardize how credit rating works. That didn't exist before this collapse, believe it or not. Also, a bunch of new rules for securitization and then some new financial transparency. It was a massive corrective effort, one that arguably has put us on a less risky path when it comes to house financing. Good things have come out of this postmortem, good actions. But look, let's be honest, new risks exist. There's risks that were just never addressed. Things will always emerge. So in the case of this 2008 housing crisis, we as a nation, we needed to learn from that. We had to adapt to it, and we had to improve. These rails were put in place and consequences as well for all those involved. If the market, though, had regulated itself, or at least had some contingencies in place, it could have prevented its own collapse. Let's be honest. Instead, a worst case happened, and a third party, the government, stepped in to save the day for some of it. But that's not always going to happen. There's not always going to be a third party that steps in to save us. So we need to protect ourselves. And that's what I'm getting at here is when plan A fails, what do you do next? Well, hopefully you've prepared a plan B. And plan B hopefully is the next best route. What happens when that one fails? Well, great planners will often have more contingency plans up their sleeves, not just the one backup, plan C, D, even F. The further you go down the alphabet, the more drastic it probably is, though, to be honest. But often, these are just the plans just to keep us going. Let's take a hypothetical for a minute. All right, bear with me. Imagine you are a small business owner. You opened a business in your hometown, and this is working for you. You enjoy what you do. It's your main source of income. You've done all the protections. You protect it with insurance. You've taken steps to adapt your business to the industry as it's changing. It's part of your financial plan. But then the town's anchor employer, let's say there's a large car manufacturing plant in your hometown. It shuts down. It's not something you necessarily saw coming. This wasn't your industry. Your business had nothing to do with the cars. But suddenly, your customers, the people that you depend on to come to your store, are suddenly unemployed. It was the main, industry of the whole town. And now everyone's unemployed. No one can afford to spend money. Businesses are evaporating. Your entire financial foundation would be at risk. Now, let's say you do a postmortem and you start to investigate and you start to look, and you might find that the signs were actually there all along. The years of declining investment, the layoffs, shifting technology trends. The car plant was the town's economic heart. But you had a blind spot when it came to looking at the broader local economy in that way. So again, in this hypothetical, your plan A was to continue to thrive locally with your business, but that died when the plant died. Your plan B might have been to adapt your local business, but that's not going to work either. You have no local business without the plant. So now you're with plan C. And plan C isn't one that maybe you ever thought was really viable, but it is in this case. And plan C might be relocating. And finding a new city and relaunching a business there, that can be a stressful, hard thing to do, especially if it was your hometown. But, if you had planned out to the degree where it was a plan, you might have said, okay, well, if I ever had to move, it would be to this place because my business could potentially compete better there. We could get the home we might want. We could try to springboard off a bad situation and maybe even offset costs by renting out our house in our current market until things got a little better again. You could come up with all the contingencies you need, but that's what they are. They're contingencies to a worst case scenario, maybe something that you missed. The postmortem is helping you kind of see what you missed and figure out what you're doing. So plan C wasn't just a fallback. It actually ended up, in this case, became your way forward. The lessons that you learn here, the point though, is that these things, if we learn them, they will sharpen our instincts, our radar for the future risk that we're managing. It makes us better risk managers. So let's say this had been you, this scenario that I just ran by. I bet you would have been way more likely when you were looking in that new town at the local economy. You would have been thinking, okay, well, is there one business that this whole thing's sitting on top of? Is this a house of cards? What happens if it implodes? What am I going to do? You're going to just look at things a little differently. So it's a valuable thing to go through. And so the scenario though, what this strategy of actually getting up and moving, this is called geographic arbitrage. Talk about this in the book. And this is something you can do deliberately, or you can do it as a backup plan. Both are fine. Moving to a newer, low cost of living area, or just a place with better job opportunities, or simply because we just want to live there because it better matches our desired life. That can all be part of your plan. That's great. Geographic arbitrage can be a part of your plan A for sure. But maybe through a postmortem or not, You can also make it part of a plan B or plan C. And, the idea of ripping up your life and moving, that's not exactly something, we all want to think that we want to do, especially not when it's on our terms. The point is, when push comes to shove, if you're depending on how committed you are to your plan, there usually is a path forward. So when it comes to acting like a professional risk manager in your projects, you need to consider all the tools that you can of the trade. I mentioned diversification before, diversifying so that you balance your exposure and you minimize your losses. So you're spreading your exposure across industries, accounts, asset types, income sources, even geographies. The idea, not one domino is going to knock down your entire life. The second one I mentioned was redundancies. This is your second tool. Creating redundancies so that you have backups ready to go. These are your fail safes, like second job, backup savings account, alternative suppliers for your business, whatever you need to add some depth and durability to your plan. Always think of redundancies. The third risk tool is testing. Test out your plan, ideally at scale. Can you weather 3 months without income? What about 12? Can you handle moving out of the country? Could you survive without a credit card? Anytime you said no, then you have risk, a vulnerability you can deal with. Increase the pressure until you find your limit. Stress test your plans so that you have a good idea how well you've mitigated. The last tool is escalation. Escalation is not a bad word when it comes to risk mitigation. It's actually the action we take when we need help. If you're overwhelmed with credit, reaching out to a nonprofit credit counselor, that's a great escalation. If you're worried about layoffs and you decide to talk to a career coach or an insurance advisor, great escalation. If you had complex questions about retirement or taxes, you want to talk to a fiduciary or a CFP, that's great. Really good escalation. Even your own behavior, when we're worried about things we don't understand about ourselves, speaking with a counselor or a trusted loved one, that's a good escalation. These are all tools to manage risk in our lives. So while you think of, and while you can't actually prevent it all, you can think of it, but you can't prevent everything. You can always learn from how something goes down. Because not trying and refusing to learn, that is how we end up with dealing with worst case scenarios over and over again. Because when I sit down with my clients, it's never just about numbers. It's always about helping people navigate life, often with more risk than they realize. My job is often to ask the hard questions and gently challenge assumptions. And often, not just help make a plan, but how to make contingencies. So whether it's a spending issue, a blind spot in estate planning, or a career risk, the right time to start thinking like a risk manager is right now. Believe me, it makes a difference. So next, let's actually discuss some of those common guardrails that we can all put on our financial lives to protect everything we've worked so hard to build. Project 4 is how you protect your finances with guardrails. This project focuses on practical mechanisms that act as financial seatbelts, tools that are going to reduce your exposure, preserve your assets, and create resiliency in the face of failure. These aren't theoretical strategies. These are the things that people put in place before things go wrong so that they don't lose everything when something inevitably does. So the first one I want to cover is insurance. I don't talk about insurance too often, but insurance is usually your first line of defense. It's the thing it's that guardrail we put in case as the what if. It's the most accessible guardrail. And sometimes, to be honest, it's one of the most underutilized one. So there's health insurance, which we can use to protect against things like medical bankruptcy. So, think about it that way. If a medical event is hitting you financially, it could completely bankrupt you. Well, not if you have health insurance. It should not be able to do that. Disability insurance can cover your income loss if you can't work, especially if you have a risk of injury in your job. It might be required, but if it's not, it could make all the difference. Losing that income potentially forever, that could completely be financial ruin. Life insurance can protect our dependents in the event of death. So life insurance is a big one. There's homeowners insurance or renters insurance. Your property is an asset, but it's also liability. So you should think about protecting that. There's also umbrella insurance that can add protection above all the standard stuff I'm talking about, including things like lawsuits and major claims. Long-term care insurance is one that a lot of people miss, but this one can help preserve assets later in life when you need nursing or in-home care. So there's lots of insurance. And so what I'm recommending here is to audit your coverage, especially every year, because most people are either underinsured or paying for the wrong things you don't actually need. The better you understand your goals, the better you can get insurance policies that actually provide you value. The next one is about legal structures that you can put in place to create asset protection. And sometimes a legal structure is the best way to protect what you built. So again, all these other projects, I've been talking about ways you can identify risks and create mitigation plans and techniques and tools to do that. But now I'm covering little pieces of guardrails you can put in place. Because even if you don't do those other things, if you create a trust, then you can protect everything you have from probate. And in some case, maybe creditors coming and trying to take it from you. I have an LLC. So if you create an LLC, you can separate your business liabilities from your personal finances. So again, it's about protection. I mentioned prenuptial and postnuptial agreements. So you can protect an individual asset in the case of a marriage. Power of attorney. You can ensure that that you have somebody appointed to act in your best interest if you become incapacitated. Wills, estate plans. These things will clarify your wishes and protect your heirs. All these things. These are all guardrails. So think about working with an estate attorney, especially if you have a higher net worth. If you own property, business, or have dependents, it can be really worthwhile because getting these right documents in place, these are real protections. The next one is segregation and access control. These guardrails can go really far because look, financial safety, isn't just about having money. It's about how you control it. So separate bank accounts for personal and business. I mentioned that just a moment ago. That's great. Separate them. But also joint accounts. They're great, but use them only when they're appropriate. When you combine accounts into joint accounts, you're increasing the risk exposure. And fraud can unravel decades of savings. And the sad truth is elder abuse and things like that, divorce, there are cases where savings get wiped out. So think about it. Beneficiary designations. I haven't talked about this one earlier, but this is a big one. When you set up all these assets, you have all these accounts, always think about setting up your beneficiary designations, meaning who has access to it when you aren't there any longer. Who else can use the money? Because what you're doing is you're excluding everyone that's not on that list. So they know that your IRA should not be accessible by anyone, but in the case that, it's inherited, the people that you listed have the amount of access that you designated. Powerful thing to do. Do it on retirement accounts, do it on life insurance, do it on investment accounts, and keep it up to date because many times it actually trumps what you have in your other documents. I mentioned two-factor auth. That's a big one. Make sure that you're setting that up, that you're actually being really smart with your credentials, especially when it comes to things like bank accounts and other financial access and services. The main idea here is don't give more access than necessary. You're keeping control. But when it comes to your closest loved ones, make sure they know how to get control when they need it. You don't want to be so tight with the control that they can't figure out how to log in and get access in the case you're not there. So put the right documents in place as well. The next one is about emergency and legal readiness. This is a guardrail that isn't just something that stops a fall. It's really about how you recover. Okay, because the other ones, it's stop the damage. This is, something might have happened. how do we actually continue to move forward? I had talked about emergency funds before. 6 to 12 months of expenses is a good general rule. I actually do 2 years, but it depends on your risk level and it depends on your goal. If you don't have a passive income goal, 6 months is fine. You want to think about your risk capacity as well here. So, try to set an emergency fund based on your resiliency goal. Legal defense fund can be really good. You can think about prepaid legal services for these. Also medical directives like a living will or healthcare proxy. These will help you recover in the case of a medical incident. In the case of job loss, having a contingency plan for caregiving, that can be a good one. Again, I've talked about secondary job plans, natural disasters. Maybe you might have to relocate. Yeah, it's really about coming up with contingency ideas in case that things go wrong. The savings is the big one. Making sure you have enough money to cover the cost to these other things. And in some case, duplicate insurance, extra insurance that can kick in, things like that can help. One last thought on this category is you can have this thing called a break glass plan. It's this document you put together in case of an emergency. So what you would do in case you lost your job or there's a lawsuit or a medical emergency, you can use it to point to the right documents, help keep yourself organized. Because again, when these things happen, they can be really stressful. So that document could be your source of truth. The last guardrail category I want to talk about is behavioral guardrails. Because again, sometimes we are our biggest risk. So spending triggers, try to find them. Look for the things that make you spend when you shouldn't be spending and find ways to limit them. Investments, automating contributions and rebalancing regularly can help you avoid some of those behavioral things I mentioned before and like panic selling. Also think about using a financial advisor or planner to look for blind spots. I offer free services, but I'm still working on getting my degree. So if you feel more comfortable, find a certified financial advisor, someone who can help you, or someone that you trust. Also think about setting up rules-based decisions for certain things. Like I don't want to spend more than X amount of dollars on non-essentials unless I wait 48 hours. There are things we can do to our own behavior to set guardrails. And by setting guardrails on ourselves, what we're doing is we're maintaining some level of control, because sometimes our own impulses can create issues. So just think about it, what your habits that can protect you and your future from being too stressed out. So no one is going to install these things for you. Let's be honest. Like these are things that you need to build into your plan. These are your guardrails. Making a designated beneficiary or creating like little habits and rules for yourselves and things like that. These are things we do to help ourselves. Government bailouts, they don't reach everyday people. Friends, family, they can offer support, but they can't outsource your personal financial resilience. You can't make them do that for you. So, these guardrails, they don't prevent the unexpected even. All they do is they limit the damage to help keep us on the road. So they're trying to prevent the worst cases so that we can weather the storm and keep moving. And many of these protections that I'm talking about, they can prevent catastrophic financial ruin. And most of them don't require all that much effort. It's good to put policies in place when obtaining a financial asset in particular, and then reviewing it regularly. You will be thankful to yourself that you did it. All right, we got through the projects for today. Covered a lot of stuff when it comes to thinking about ruin and risk in our lives. I covered some of the key techniques and strategies for mitigating risk to your financial livelihood. Things like a lack of buffer, over-leveraged debt, job loss, medical emergencies, major market downturns, fraud, lawsuits, lifestyle creep, divorce. These are common vulnerabilities, and any robust financial plan needs to account for them. Doing nothing leaves you on autopilot. Hands would be off the wheel, ship drifting towards a storm. And in that case, all you can do is hope that you're going to come out the other side. If you do it that way, you're just going to be left to assess the damage and figure out whether you can still reach your destination. But with a mitigation plan in place, you won't be caught off guard. You'll spot the storm early, you'll steady the wheel, you'll be ready to navigate through it. Because there are no guarantees in life. You may still take damage, but you'll have increased your chances of making it through and emerging on the other side, ready to sail under the clear skies again. That's what this is about. This is about resiliency. And I didn't cover everything. There's a lot of topics when it comes to risk, many scenarios, things I've not experienced or even imagined. And that's why the unknowns can be scary. But for today, out of scope are things like psychological collapse during crisis. What happens when we can't even manage because the crisis is too large? Or what are some of the local and federal assistance programs that actually could help us in some of these cases? And what are some of the common predatory risks that we might face? All out of scope. Maybe I'll get to that in a future episode. But now I just wanted to cover some of the basics when it comes to the big risks in our lives and what to do about it. But now let's circle back to Gao and Noctis. I had introduced them at the beginning of the episode, and each of them were struggling when it came to some of the big risks in their own lives. Gao had been living on instinct, and he had met with a financial advisor and saw how far off track he was from even a basic retirement, and that was just a wake-up call for him. He wants to return to traveling the world and knows that he has to make some real changes. And so with guidance with this advisor, he starts to set some concrete goals, starts by cutting expenses by downsizing and relocating to a lower cost area. So some geographic arbitrage for him there. And for the first time, he begins to picture the life he truly wants and the things that might go wrong along the way. So he's not just going on instinct. He's actually planning ahead and coming up with contingencies. And he's acknowledging where his instincts have failed him in the past, building even stronger resiliency about what he might decide in the future. He reviews and adjusts his insurance. He updates his budgets. He adds guardrails to his decision making. For every new project, he has a plan. And for every plan, he has a backup plan. And with practice, Gao learns to course correct. And before he knows it, he is steadily moving toward the life that he envisioned. Noctis had grown up with everything that he could possibly want. He had money, friends, a supportive father. But the loss of his father to Marfan syndrome at the age of 55 was a wake-up call. Not yet tested himself, he worries he might have the disease as well. He has inherited his father's estate and he's preparing to marry, but he's unsure if he's equipped to carry out his father's legacy. His health, his relationships, his newly acquired assets. Noctis is worrying that these things will continue to go wrong and that he might be letting his father and his friends and his fiancée down. Luckily, one of his friends sees this struggle and is offering to help. They set out on a road trip, and the four friends gather around a campfire, sharing worries, but focusing on Noctis and his problems and worry and concerns about his future. And together, they pre-mortem each concern, building contingencies for each problem. They might not actually call it that, but that's kind of what they're doing. And ultimately, a backup plan forms, and Noctis begins to feel more confident. They also, as they think about the loss and his father's premature death, they do a bit of a post-mortem on that. They realize that Marfan syndrome isn't routinely screened for, and that inheritance of the condition is a coin flip, meaning that they couldn't have possibly known in advance since Noctis's grandfather didn't have it. Even though they understand the root cause, Noctis acknowledges that there wasn't much that could have been done differently back then. But now he has the knowledge, and they decide that Noctis should get tested himself and plan for treatment if necessary. It's something he needs for himself and for his fiancée before they can decide whether they want to have children. And the next morning, him and his friends, as they head home, Noctis just has a feeling of gratitude, not just for this plan, but because he has friends who listened and helped him face hard truths and support his path forward. So whether your dream is to travel like Gao or manage a legacy like Noctis, risk is always going to be part of the journey. but it doesn't have to derail you. You just have to prepare for it. The worst thing you can do is ignore it. And yet that's what a lot of people do. And when things are going well, it's easy to think they'll keep going well. I think that's just natural. But lived experience is no guarantee of the future. Anyone who's lived through the Great Depression or even the 2008 recession I talked about, they know that. The longer we enjoy financial comfort, the more tempting it is to believe it's permanent. But it's the prepared ones who come through the storm intact, sometimes even strong enough to help others along the way. And that's why I do what I do. As a retired risk manager, I've spent my career helping people identify where things could go wrong and how to be ready when they do. And if you're unsure how to manage risk in your own financial plan, I do offer free one-on-one sessions. You can sign up on my website at escapetheclock.com. I'm here to help. All right, so my final thoughts here. Mitigating risk, it's a lifelong practice. But it is something that you can learn. Anyone can learn this. In my early days, I personally invested in a home, my job, and the stock market. That was my investment portfolio. When the housing market collapsed in 2009, I nearly lost everything. My wife and I, we were in a tough state at that time. My investments in myself paid off though and saved us. Even though we lost our home in this collapse, we had 2 mortgages on the home. We had a hard time being able to sell it or anything. It was a tough situation because I had made a move and I had built some skills and I had moved across the country, taken a new job. That actually allowed me to gain equity. And that equity allowed me to offset my losses in my home. So I didn't realize it, but I was diversifying more just by the moves I was making in my own skills and in my job through the stocks I was gaining. Later, though, all that new equity, that made me overexposed to stocks and the tech category. And that was a whole new risk, one that history could have repeated again. But luckily, I learned my lesson, and I was at that point looking and trying to mitigate the risk. And I'm happy I did, because when the tech sector took that huge hit into 2024, early 2025, I would have lost a lot more than I had if I hadn't made the moves I did. But I was ready. I had learned. And so I was diversifying and moving away from that and balancing my portfolio, because every setback, it's a lesson. In risk mitigation, it's not about avoiding storms. It's about how to stay afloat and stay on course through all of the storms that we're going to have to eventually face. And before concluding this episode, I just want to hear from you. What are the big financial risks that keep you up at night? Post in the episode comments or email me at escapetheclockmedia@gmail.com. I may give you a shout out on a future episode. I'd love to hear from you, and I'm sure the community would as well. Thanks for tuning in to today's episode. I hope you rest a little easier knowing you have some contingencies in place, keeping you on track for your escape plan. I'm Daniel C. Rogers, and I'll chat with you next week. Thanks for tuning in to this episode. Remember, while I'm not yet a financial planner, I am getting my degree in wealth management. You should take anything you've heard here as tips and advice to making your plan. To learn more, visit www.escapetheclock.com. There, you can find the book, resources, including the planner, and you can even schedule time with me. Please remember to like and subscribe so you don't miss an episode. Thanks for tuning in, and I'll catch you next time.